It takes a human being exactly 300 milliseconds to blink an eye. It is a biological limit you cannot overcome. But in those exact same 300 milliseconds, a high-frequency trading algorithm can execute 10,000 distinct financial transactions. It can analyze the global market, buy a block of shares, and sell them back to you at a premium, before your eyelid has even opened back up. When you picture Wall Street, you probably imagine shouting men in tailored suits on a chaotic trading floor. You imagine ringing bells and paper tickets flying through the air. That version of Wall Street has been dead for decades. It is a nostalgic hallucination, kept alive by movies to make you feel like humans are still in charge. The real Wall Street does not have windows, and it does not have human brokers. It is a massive, heavily fortified, refrigerated server farm located in Noir, New Jersey. Welcome to the era of the algorithmic harvest, where the stock market is no longer a place to build real businesses. It is an invisible, high-speed extraction engine. Today we are pulling the plug on the illusion of the free market. We will show you how the smartest physicists and mathematicians on Earth hijacked the financial system, not to build better companies and not to provide liquidity, but tax your reaction time. Because in the modern market, you are not trading against other investors. You are trading against the immutable laws of physics. To understand how you are being legally robbed every time you tap your screen, you must understand the architecture of the market. When you open your brokerage app, you see a ticker tape of moving prices. You see a ledger of buyers and sellers, publicly displayed for the world to see. This is known as the lit market. It is designed to give you the comforting illusion of total transparency. But what you're looking at is merely the retail storefront. It is the shallow end of the pool, where the tourists are allowed to paddle. Right beneath it lies a massive, opaque parallel universe known as the dark pool. Dark pools are private trading networks operated by massive global banks like Goldman Sachs and Barclays. Originally, they were designed for a legitimate purpose. If a pension fund wanted to sell 10 million shares of a company, doing it publicly would cause a market panic. The dark pool allowed them to quietly match massive block orders without instantly crashing the price. But Wall Street never leaves a shadow unexploited. Today, nearly half of all stock trades in the United States take place entirely in the dark. Prices are negotiated in secret, invisible to the public, until the trade is already completed. Banks promised their institutional clients that these dark pools were safe havens, free from predatory algorithms. But federal investigations later revealed that these banks were secretly granting high-speed trading machines VIP access to the dark pools. They threw their own clients into the shark tank just to collect the trading fees. The supply and demand curve you see on your screen is fundamentally incomplete. You are making financial decisions based on a heavily manipulated version of reality. But the real invisible violence happens in the fractions of a second between those markets. Enter the high-frequency trading firms. These are secretive Wall Street trading companies armed with supercomputers and microwave transmitters. They do not care about a company's fundamentals, its quarterly earnings reports, or its future products. They only care about one thing: a microscopic delay. Imagine you open your phone right now and decide to buy 100 shares of Tesla. You press the buy button. But before your order officially reaches the public market, an algorithm detects your mood. Imagine you are standing in a supermarket, reaching out to buy a discounted television. Just before your hand touches the box, a man in high-tech running shoes sprints past you. He grabs the exact television you wanted, and then he turns around and forces you to buy it from him for $1 more. You have no choice but to pay. In the real world, we would call this a scam. But on Wall Street, when a machine jumps in front of your order using private fiber optic cables, it is legally classified as providing liquidity. They do not create any real value. They simply harvest the friction of the system. This is not a battle of economic intelligence. It is a literal arms race of physics. Because in this ecosystem, speed is the only currency that matters. Consider the legendary Spread Networks project. A secretive group spent over $300 million to lay a single fiber optic cable from Chicago to New York. They blasted through the solid granite of mountains. They bored under rivers and trenched through farmland, maintaining the absolute straightest line geographically possible. All of this destruction and capital expenditure was for one singular purpose: to shave exactly 3 milliseconds off the transmission time of a trading signal. 3 milliseconds. A margin of time entirely imperceptible to the human brain. But to an algorithm, 3 milliseconds is an absolute eternity. It is enough time to view the market, steal the guaranteed profit, and disappear without a trace. And the physical extortion does not end with cables. Inside the heavily guarded data centers of the major stock exchanges, space is sold by the millimeter. Trading firms pay millions of dollars just to put their computer servers right next to the exchange's main server. It is like paying for a VIP seat at a concert, just so you can hear the music a nanosecond before everyone else. Because when you are measuring speed in microseconds, the physical length of a copper wire matters. Wall Street has successfully monetized the speed of light, and they are using it to outrun you. But you might be thinking, how does this affect me? My trading app is completely free. I do not pay any commissions anymore. That is the most brilliant and devastating psychological trap ever set for the retail investor. If a financial service is offered to you for free, you are not the customer. You are the product being sold. Just like social media platforms sell your search history to advertisers, your broker sells your trading behavior to Wall Street algorithms. When you swipe up on your beautiful, gamified trading app, your broker does not send your order to the public stock exchange. They bundle your orders and auction them off to massive, high-frequency trading firms. These firms pay your broker billions of dollars a year just for the exclusive right to execute your trades. Why would a Wall Street behemoth pay billions of dollars to handle the tiny orders of everyday retail investors? Because retail orders are highly predictable, poorly timed, and incredibly easy to exploit. You are providing the uneducated, slow-moving liquidity that the predatory algorithms need to feed on. Your broker traded your right to a fair market price in exchange for a corporate kickback. You did not get a free trade. You were blindfolded placed on a conveyor belt and fed directly into an algorithmic meat grinder. It is not the democratization of finance. It is precision-targeted commercial harvesting. The defenders of this system claim that these machines provide vital liquidity to the markets. They claim that algorithms make trading cheaper and faster for everyone. But what happens when the machines malfunction? On the afternoon of May 6th, 2010, the world found out. In an event now known as the flash crash, the United States stock market experienced a catastrophic algorithmic failure. In a matter of minutes, the Dow Jones Industrial Average plummeted by nearly 1,000 points. Massive corporations with billions of dollars in real-world assets suddenly traded for a single penny. Over $1 trillion in wealth was vaporized in the time it takes to drink a cup of coffee. What caused it? Algorithms flooding the market with thousands of fake orders, designed to create a false illusion of intense selling panic. When competing algorithms detected this synthetic panic, they did exactly what they were programmed to do. They instantly withdrew all of their money. The high-frequency machines simply unplugged their servers and walked away, leaving the human investors, the pension funds, and the retirement accounts to absorb the devastating impact. The liquidity that these machines supposedly provide is nothing but a mirage. It is there when the market is calm and highly profitable. But the moment chaos strikes, the machines evaporate into the digital ether, leaving the everyday taxpayer to navigate the burning wreckage of the financial system. So the next time you look at the flashing numbers on your smartphone, do not mistake that digital theater for a fair market. The stock market is no longer a place for human beings to invest in human enterprise. It has been transformed into a sprawling, global compute farm. A system designed by billionaires, engineered by physicists, and powered by the relentless exploitation of time itself. When the house can legally see your cards before you even place your bet. The game is not just rigged. It is fundamentally broken. If you are not the one writing the code, you are simply the fuel being burned to power it. We do not just follow the money. We expose the machines that extract it. This is money noir.